Hello and welcome. This video is for those who are planning to pay or receive a rent of more than 50k per month for any property. Now the property here can be a residential property, say a house, flat or villa, or a commercial property like office, factory, shop, etc., or even a plot of land. If you have already rented out such a property or you live in such a property or use it for any commercial purpose, even then this video is going to be useful to you. In this video, we are going to talk about the key things that you need to remember from the income tax perspective when you pay or receive a rent of more than 50k per month. We are going to discuss the income tax provisions for both tenants and property owners. That is, if you are a tenant, then what are the things that you need to consider before you pay a rent of more than 50k per month? Similarly, if you are the property owner, then what are the important things for you to remember when you rent out such a property? But before that, let's first see what kind of properties are covered here. First, residential property like house, flat or villa. 2. Plot of land, even vacant land is covered here. 3. Commercial property like factory, office, warehouse, shop, etc. when the rent for the property is more than 50k per month. Now, in case of commercial property, if you use it for the purpose of your business and if the turnover from your business is up to 100 lakh, or if you are a professional and you use this commercial space for the purpose of your profession and the turnover is up to 50 lakh during the last financial year, then commercial property in such situations would be covered here. To put it differently, this video is not about the property for which the rent that you pay or receive is up to 50k per month, or in case of commercial property, if the turnover from the business that you run is more than 100 lakh, or in case of profession it is more than 50 lakh during the last financial year. Let's say there is a house in Bengaluru for rent and the rent is going to be 60k per month. Now when it comes to renting out of this house, there are two people involved here. One, the tenant, that is the person who's going to stay in this house. The other is the property owner, that is the person renting out this house. Now the tenant here can be a resident Indian or a non-resident Indian, but the property owner has to be a resident Indian. To put it differently, property owners who are NRIs are not covered here. Let's now see, if you are a tenant, then what are the things that you need to consider? First, you need to deduct TDS at 5% or 1 month rent, whichever is lower. For those who are not familiar, full form of TDS is tax deducted at source. Here, a person called the deductor, who is liable to make payment of specified nature to any other person called the deductee, shall deduct tax at source and remit the same into the account of the government. Let us consider the same example here. Rent 60k per month. Here the deductor is the tenant and deductee is the property owner. Now the deductor, that is the tenant, is first required to deduct tax at source, that is the tax is going to be deducted from the rent that is payable to the property owner, and this tax has to be paid to the government. Once the tax is paid to the government, the tenant is required to issue the TDS certificate to the property owner. Now, on the basis of this TDS certificate, the property owner can claim tax credit, and the property owner can either claim refund of this tax credit if there is no other tax liability, or this tax credit can be adjusted against any other tax liability at the time of filing income tax return. So we can say that this TDS is not an expense for the property owner. Next, this TDS has to be deducted during the last month of the year or the last month of the tenancy, whichever is earlier. That is, if you stay in this house for the entire year, then you need to deduct TDS in the month of March. But if you vacate this property during the financial year, then you need to deduct TDS during the month in which you vacate this house. Another important thing to remember here is, if the property owner does not provide you the PAN, then the rate of TDS would be 20% instead of 5%. Now, whether you deduct this TDS at 5% or 20%, this tax has to be paid to the government within 30 days from the end of the month of deduction. To have a better understanding of this concept, let's consider the same example again. That is the house for rent at 60K per month. Here we have two scenarios. First, you stay in this house for the entire year. Second scenario, you vacate this house during the year. Let's now consider the first scenario. If you stay in this house for the entire year, then rent for the year would be 7.2 lakh. That is 60K multiplied by the number of months, that is 12. And TDS at 5% on this value would be 36K. Now, as you have stayed in this house for the entire year, you need to deduct tax during the last month of the year, that is March. So, the rent for the month of March would be 60K. From this, you are going to deduct TDS of 36K and the balance of 24K would be paid to the property owner. Now, the second scenario. Here, let's say you vacate this property on 31st December. So, the rent for the year would be 5.4 lakh, that is 60K multiplied by number of months, which is 9 here, that is from April to December, and TDS at 5% on this value would be 27K. As you vacate this property during the month of December, you need to deduct TDS during the month of December. Now, rent for December is 60K. From this, you are going to deduct TDS of 27K and balance 33K would be paid to the property owner. Now, this TDS, whether it is 36K or 27K, depending upon the scenario in which you fall, this TDS has to be paid to the government within 30 days from the end of the month of deduction. Now, let's switch back to the first scenario. Here, the month of deduction is March. So, end of the month would be 31st March. You need to pay TDS within 30 days from end of the month. So, that is 30 days from 31st March. So, you need to pay TDS by 30th April. Now, let's consider the second scenario. Here, the month of deduction would be December. So, end of the month would be 31st December and you need to pay TDS by 30th Jan. Now, the next question is how to pay this tax. This tax can be paid online using net banking. You can use your debit card or even credit card and make the payment. Here I am not going to explain you the step-by-step process of how to make this payment because the process is very simple. The instructions on the screen is self-explanatory, so it would be very easy for you to follow these instructions and make the payment. But let me explain you briefly the process involved. You need to navigate to the income tax portal, log into your account, select e-pay tax and enter relevant information like financial year, PAN of the property owner, what is the rent amount, TDS, etc. and make the payment. If you don't want to log into your account or if you have not yet created your account, then you can use the option e-pay tax. All you need to do is to enter your PAN, mobile phone number and enter other relevant information and make the payment. By chance, if you are making payment using net banking option and if you have account in any of these banks, then you need to click the link on the screen, click confirm. This would navigate you to another portal. Here scroll down and select form 26QC and make the payment. Here also I am not explained the step-by-step process of making the payment using form 26QC. But this is very similar to making payment using form 26QB and I have already explained this process in my earlier video. If you would like to know more about it, you may consider watching the earlier video, the link in the top right corner. Here you need to select form 26QC and enter relevant information and make the payment. Once you make this payment, you need to generate something called TDS certificate, that is also known as form 16C. Now this form has to be generated online and it has to be generated within 15 days from the date you make the payment of tax. And once you generate this TDS certificate, you need to send this to the property owner. Now, this is the format of the Form 16C. To generate this Form 16C, you need to navigate to the Traces portal, log into your account and generate Form 16C. If you have not yet registered, you can register yourself as a new user and generate Form 16C. Now, what if you don't pay this TDS within the time limit of 30 days? If so, first you need to pay interest at 1.5% per month or part of the month, plus late fee at 200 rupees per day, subject to a maximum of TDS amount. Say for example, the TDS that you need to pay is 1000 rupees and the number of days that you have delayed is 6. So 200 multiplied by 6 would be 1200, but the late fee here would be capped at 1000 rupees. Plus, you may be required to pay a penalty of 10k. Now, what if you don't issue this TDS certificate to the property owner within the time limit of 15 days? If so, you need to pay a late fee of rupees 100 per day. Now, whenever there is a delay but you don't pay this interest or late fee as applicable, then the income tax department would send you the demand notice and you can pay this when you receive such demand notice. Now let us see, if you are the property owner, then what are the important things that you need to remember? Now, whatever provisions I have so far explained, these are applicable only when the property owner is a resident Indian. To put it differently, if you are an NRI, then the rate of TDS would be not 5% but much higher than that. Second, ensure that you share your PAN with your tenant. Otherwise, the rate of TDS for you would be 20%. If you do not have PAN, ensure that you get one. 3. Ask for TDS certificate from your tenant. 4. Periodically check your tax credit statement to see whether the tax that is deducted by your tenant is actually credited to your account. You can do this by checking your annual information statement, AIS in short. If you would like to know how to view or download AIS, you may consider watching my earlier video, the link in the top right corner. Fifth one, whatever tax credit that appears in your AIS, you can either claim refund if you have no other tax liability, or you can adjust this against any other tax liability, and this can be done at the time of filing your income tax return. That's all for today. Hope the concept is clear to you. Thank you for watching.